Okay, good afternoon, everyone, and welcome to this 1 hour discussion on sovereign rating during crisis. My name is Gregory Claeys. I'm a senior fellow at Bruegel, and I'll be moderating the discussion today. So the idea of today's panel is to discuss why sovereign ratings, in Europe in particular, have, for the moment at least, behaved differently during the COVID-19 crisis than during the great financial crisis and the Euro crisis. Even though we have seen a much deeper crisis, in particular in Europe, both in terms of GDP, but also from a financial, from a public finance perspective, we have seen much bigger deficit and an increase, high increase of public debt. Given also that these ratings are very important in our financial system, in particular for governments, they are important to get access to funding from private institutions, but also they are important in particular in the euro area because the ECB, the European Central Bank, is using the rating to decide on the eligibility and haircut applied in its collateral framework, which make it also very important for government. So because of this reason, it's crucial to understand why this time is different and why rating have behaved differently than in a previous crisis, and to understand, yeah, exactly the reason behind that. So to discuss this very important issue, I'm really delighted to welcome three great speakers with me today that will be able to reflect on this topic from different perspectives. So let me introduce them, let's say in alphabetical order. So first we have Judith Arnal Martinez, who is head of the cabinet of the Secretary General of the Spanish Treasury. Welcome, Judith. Then we have Alexandra Dimitrijevic, who is the global head of research at S&P Global Ratings. And finally, we have Daniel Vernazza, who is the chief international economist, sorry, at UniCredit, the Italian bank. So let me first thank you, all of you, very much for taking the time to participate in this event. And before I give the floor to our three panelists, let me quickly explain to you how we'll proceed during the event. So we will start with some very short introduction from our three speakers, 10-minute max. I'll try to be quite harsh on that. So do not try to go more than 10 minutes, each of you. And then it will be followed by a discussion, and in particular from questions from our online audience. So for our online audience, you can ask questions during the event using sil.do, which is a website that you find at sil.do. Or you can also find it directly on the webpage of our event on Bruegel's website, using the code, the hashtag sovereign. That's the way to find it on the Slido webpage. So without much further ado, let me start first with Judith, and by asking you a question. Judith, thanks again for joining us today online at Bruegel. So Judith, actually, you just finished a paper with some colleagues from the Spanish Treasury that is called Procyclicality of Credit Rating, Is It Different This Time?, in which you discuss the potential issues related to the use of sovereign rating in the financial system, especially during the previous crisis. And you also investigate the main reason that could explain why this crisis could be different as far as rating are concerned. So maybe you could start by telling us what are your main points and summarize a bit the result of your research. And I think you have some slides, so you can share your screen if you want.
Okay. Thank you very much, Gregory, and good afternoon, everybody. First of all, I would like to thank both Gregory and Bruegel for hosting this interesting event. So as you were saying, indeed, we have produced a working paper at the Financial Analysis Department of the Treasury. So as it is well known by everybody, credit ratings play a crucial role in reducing asymmetric information in financial markets and are used for a wide variety of purposes. However, financial literature also provides ample evidence that credit rating agencies behave in an excessively procyclical manner during recessions, assigning worse credit ratings to issuers than their actual credit profile would deserve. Credit ratings are key in terms of ensuring access to funding sources both by sovereigns and corporates. Therefore, any excessive procyclicality would unnecessarily impair access to funding sources. The situation can become even more acute when an issuer loses the investment grade status, thus becoming a fallen angel and triggering additional losses and fire sales. But even if an issuer stays above the investment grade rating, the situation can also be difficult because of the existence of sovereign ceilings that can lead to inaccurate credit evaluations of some issuers. In a nutshell, excessive procyclicality by credit ratings can have a negative impact on financial stability. As you were saying before, the COVID-19 crisis has led to a setback for the world economy, which is unprecedented since the Second World War. However, what we see is that if compared to the great financial crisis that started back in 2008, the number of rating downgrades has been significantly lower. And it is now that I want to share my screen to show some slides to you. I hope that you can see it properly. So here, basically, what we show in this graph is the evolution of the Eurozone sovereign average rating between 2005 and March 2021. So as you can see, there was a significant downgrade between 2008 and 2013. And the average downgrade was of 4 notches. Of course, this was an irregular decrease, which mainly took place between 2010 and 2012. The situation then stabilized a bit thanks to the very well-known Whatever It Takes by Mario Draghi. And already in 2014, an improvement of the situation started taking place. However, by the beginning of the COVID-19 crisis in mid-March, we have not recovered, Eurozone sovereigns have not recovered pre-great financial crisis rating levels. We were a bit in the middle, so 2 notches above the minimum of January 2013 and 2 notches below the maximum of 2018. Of course, the sovereign downgrades that took place during the great financial crisis and then during the euro area sovereign debt crisis were not homogeneous. So-called peripheral member states suffered more than core member states, and even inside the group of so-called peripheral member states, there were differences. So the downgrades were especially acute in the cases of Greece and Cyprus, with the downgrades of 16 and 15 notches, respectively. Then there was a second group with downgrades of 8 notches, which are the cases of Ireland, Spain, and Portugal. And finally, we have downgrades of between 4 to 6 notches in the cases of Italy, Latvia, and Slovenia. So basically, this is what happened during the great financial crisis and the euro area sovereign debt crisis. But the situation is totally different during now in the COVID-19 crisis. So, of course, if you look at the axis, we are talking about differences between 16.9 and 16.5. So euro area sovereign ratings have been very, very stable during the COVID-19 crisis. We have only seen 3 downgrades, and we have even seen 4 upgrades, the very latest one taken place by S&P this Friday for Greece, with an upgrade of both the rating and the outlook, which is very, very good news. If we move to corporates, though the panel is centered on sovereigns, but if we move to corporates, we can see also a similar evolution. So at the very beginning of the great financial crisis between 2008 and 2010, corporate ratings were a bit more sticky. But downgrades took place, especially starting with the euro area sovereign debt crisis, mainly due to the sovereign bank feedback loop. Here we show the average ratings of three major stock indexes, DAX 30, IBEX 35, and CAC 40. We see that in the case of the IBEX 35, the decrease in rating was much bigger, much larger. And we think that this is due to the fact that the banks have a bigger weight in the IBEX 35. Also, due to the sovereign bank feedback loop and to the other idiosyncratic elements. But if you look at what has happened with the COVID-19 crisis, we have seen that ratings are much more stable, and any rating actions have mainly taken the form of reviews to the outlook. So indeed, we can come to the conclusion that this time is different. So it is good to know the underlying reasons as to why this might be the case. So we have identified 5 reasons. First one is that the COVID-19 crisis has nothing to do with the great financial crisis and the euro area sovereign debt crisis. So the COVID-19 crisis is a crisis of an exogenous nature, health crisis that is not related to the accumulation of fiscal and financial imbalances, which was the case with the great financial crisis. Second, the policy response has been completely different. Now with the COVID-19 crisis, there has been no doubt that something had to be done. And very strong fiscal, monetary, and macroprudential measures have been adopted, which it was not the case during the great financial crisis, and especially with the euro area sovereign debt crisis, where many political debates took place as to what the right policy response had to be. Third, we also think that credit rating agencies had more margin of maneuver during the great financial crisis, because starting rating levels were much higher. As I've said before, now we are middle ground, so we have not recovered pre-great financial crisis levels. So it's true that there is less margin of maneuver for rating downgrades. Fourth, we believe that the sovereign ceiling has not entered into force this time. So we have only seen 3 rating downgrades, and we've seen 4 rating upgrades in the euro area. So basically, there have been no negative spillover effects over corporates, over domestic corporates coming from downgrades of sovereigns. And finally, of course, the regulatory response undertaken at the EU level with the credit rating agencies reforms in 2009, 2011, and 2013 has of course been key in also reducing a possible procyclical behavior by credit rating agencies. Anyhow, I mean, we have identified these 5 reasons, and it looks like this time is different, but also a word of caution. Because the COVID-19 crisis has unfortunately not come to an end yet. And especially we are comparing 2 very different crises, as I was saying before. So in order to know whether indeed credit rating agencies have a smaller procyclical attitude behavior than before, we would need to test to run the test against an endogenous crisis. Of course, we need to wait until a new endogenous crisis takes place to test it against the great financial crisis and the euro area sovereign debt crisis. But hopefully we're far from being able to run this analysis. This would be good news because there would be no endogenous crisis. So thank you.
Thank you very much, Judith, for this great introduction to the topic. I'm going to give the floor now to Alexandra, because we have seen those 5 different reasons, but I think you're the best place coming from S&P to tell us what do you think are the main reason why credit rating agencies, of course, S&P, of course, have reacted so differently? Is it because you changed the way you design those ratings? Is it because the crisis is different? Is it one of the other reasons that was mentioned by Judith? Can you tell us a bit more about why this time is so different?
Yes, so first of all, hi Gregory, and thank you for the invitation on this panel, and very nice to meet Daniel and Judith today. And it was very interesting to hear Judith's research. So I will be speaking obviously on behalf of S&P Global Ratings, not the other rating agency, in terms of explaining our approach. And before getting to the why sovereign ratings have behaved differently, I'd like to just start by getting the facts on the table about what the impact of the pandemic has been on sovereign ratings globally. So since the outbreak of COVID-19, S&P has downgraded 32 sovereigns globally, which is close to a quarter of rated sovereigns. And we currently have 20 on negative outlook. And it's a not dissimilar proportion to corporate, actually. The majority of these downgrades have taken place at the lower end of the rating scale for emerging market or frontier market. And this is because they entered the pandemic with pre-existing vulnerabilities, and also they had much less flexibility and resilience to deal with such a major health shock and its economic consequences. And just also to finish on the facts that there actually was a record 7 sovereign default in 2020, mostly in Latin America and the Middle East. So in Europe, as Judith stated, there have been fewer rating actions than during the great financial crisis. It's the same in other advanced economies where there have been mostly outlook changes still now. So we revised the outlook, for instance, on Portugal from positive to stable, on Spain from stable to negative. And indeed, last week we announced the upgrade of Greece from BB- to BB. And that's to reflect the expectation of a rapid and substantial improvement in budgetary and economic performance once the pandemic is over. And it reflects the combination of the enhanced government effectiveness and structural measures, as well as the major boost via the ECB and the EU Next Generation Fund. So now we have the facts. Let me get to the reason as to why ratings have behaved differently in Europe. And out of the 5, I would say for us, there are 2 main reasons. The first one is that the nature of this crisis is very different, as Judith was saying. It is first and foremost a global health crisis, and it constitutes a huge shock, but it's exogenous and temporary. And as Judith mentioned rightly, it's unlike previous crises, it's not rooted in fundamental financial, economic, or external imbalances. And the epicenter is not a failing financial system. And if anything, we had a more resilient banking system that has actually supported the monetary policy efforts. So in that context, the priority for governments has been to contain the pandemic and preserve the economic fabric by protecting the household and the corporate that have been first hit in that crisis compared to the previous one. So they're focusing really on providing that bridge until economies and employment recover. And we consider that this was necessary to avoid the destruction of human and economic capital, which would have had much more damaging long-term and severe consequences. Now, of course, as a result, budget deficits have widened across the board, and this has led to a surge in government debt. But that takes me to my second point that is crucial to understand the differences in our assessment of sovereign creditworthiness. And that is the policy response. And here I'm focusing on mostly on the advanced economy and particularly in Europe. The size, the speed, the coordination of the response at the European level have been unprecedented, and they have proven very effective in cushioning the near-term effect of the pandemic. So in addition to the massive fiscal direct and indirect national measures, there have been significant measures both at the ECB and the European institution level. So starting with the ECB, we've had rapid and substantial action that really suggests to us that the monetary union is now much better equipped to deal with the widespread economic crisis. They have been very effective at keeping government funding costs low, across the Eurozone, ensuring that monetary policy transmission works effectively, but also it has enabled fiscal policy measures at the national and European level to work without impairing individual sovereign access to the market. So this is a stark contrast with the funding concern that sparked in the 2011 Eurozone sovereign debt crisis, where you will remember we had episode of market stress affecting individual sovereign. You will recall that several had to seek support from the ESM or even seek funding outside of the monetary area. And of course, we had 3 defaults of Eurozone sovereigns, 2 from Greece and 1 from Cyprus in that period. Here, the situation is very different, and the ECB's widened again the PEPP envelope and extended it until March 2022. So really signaling that it will continue to ensure that governments can finance the extraordinary fiscal measure at low cost. And for us, really, that has played a significant role in the sovereign creditworthiness, as it's really underpinned our view of the credibility and the effectiveness of the monetary policy. And this is a central part of our ratings. And we can come back to corporate later, but it has also proved really effective in actually keeping a good access to liquidity and favorable funding conditions for corporates, including at the lower end of the rating scale. And therefore, we've had less corporate default so far than in the great financial crisis. Now, in addition to the monetary response, the response at the European institutional level has made a huge difference. So the next generation EU plan has been both large and redistributive, and it has been really important in addressing the way the pandemic has impacted in an asymmetric manner the sovereign in Europe, and provided effective support to the most indebted. And furthermore, by issuing debt in the market on this scale, the EU is this is really providing some support to the EU status as a reserve currency. So clearly, monetary and fiscal responses have worked. They have provided a significant buffer in the midst of the pandemic. But on my last and very important point, and Judith mentioned that as well, the story isn't over yet. And I think this is really important. There are a number of significant challenges ahead that could still impact sovereign ratings. On the health front, as we know, the pandemic isn't over. In Europe, we're facing challenges with the vaccine distribution. We still have lockdowns. And I think that the dramatic situation in India now also reminds us that the next few months are going to be a race between the vaccine rollout and the new variants globally. The second big challenge will be for government, that will have to manage a very delicate balance in withdrawing some of these extraordinary measures. And timing is going to be a challenge, because if you have a premature austerity, then it could impair recovery. But then if it lasts for too long, it could lead to further fiscal imbalances and also prevent structural changes to the economies. And there are still lots of vulnerabilities in the corporate sector that could lead to more bankruptcies and therefore materialization of contingent liabilities for the sovereign. So the evolution of sovereign rating in Europe in the medium to long term will be shaped by, one, the return to sustainable level of fiscal balances, and second, and more importantly, the sustained economic growth. So we know it's going to take time to deleverage. It's going to take several years. Obviously, the very low interest rate buys time, but it isn't a substitute for all the fiscal and structural reforms that will be necessary to rebuild a sustained long-term growth. And it's really important to build back this fiscal and monetary margin to face future crises. And also there are major challenges ahead. Just to cite two, the pandemic has accelerated the digitization of the economy, and this has structural implications on a number of industries, as we know. And second, the fight against climate change is another priority that can't wait. And so to finish on a positive note, the EU Next Generation Plan is really placing the right emphasis on this productive investment supporting a digital and green growth. And maybe through the Q&A, I can get a bit more in detail. We've published today a very interesting study on assessing the potential impact of the EU Next Generation Fund on the European economy. But I leave that for later, and I will stop for now.
Thanks very much, Alexandra, for this comprehensive reply. I now give the floor to David. David, you wrote a paper with some colleagues from UniCredit a few years ago. I think it was in 2014 with Eric Nielsen and another co-author. And I think the title was called The Damaging Bias of Sovereign Ratings. So maybe you can remind us a bit what this was about, and actually if the current situation has changed your views on ratings and how ratings are formed, and if you believe that they still have this damaging bias that you were mentioning a few years ago.
Thank you, Gregory, and it's very good to be here, and hi, everyone. Before I get to that paper, maybe if I just start off with some basic comments on ratings and how important they are. I mean, ratings, of course, reflect the agency's estimates of the probability of default over a given period, usually a few years, maybe 3 years. There is an important role for ratings when done well in reducing information asymmetries and principal agent problems. It's clearly inefficient for any single firm, particularly small ones, to conduct their own assessment of creditworthiness. Ratings are a relative measure of creditworthiness, I think. And so in theory, firms would have to sort of rate the whole universe in order to come up with the right ratings. And there's, of course, on the principal agent problem, requiring a minimum rating can stop the asset manager from investing in high risk products. The credit rating agencies have a lot of power. There are very few of them. I think the big three dominate the market with about 95% of the market. Their market power is reinforced by the reliance of regulators and investors on their ratings. Ratings reflect or are, through regulation, they affect the risk weightings in capital standards of banks. And many investors are required to hold investment grade securities, which creates this sort of fallen angels effect as if they're downgraded through this the investment grade boundary into junk. And ratings clearly remain very important for investment decisions and operational frameworks of central banks, even after the changes that have been made at the regulatory level to try and reduce their impact, particularly in regulators' recommendations. In terms of our 2014 paper on the damaging bias of ratings, what we did there is actually followed many other authors in trying to come up with a simple model to explain most of the movement in ratings over time. This was done for sovereign ratings, and then we called this the objective component of ratings. We had a number of variables, ones that you would expect to be in there: GDP growth, public debt to GDP, measures of governance, and the rule of law. All these things that the rating agencies say that they are important in their decision making. And then we looked at the residual and called that the subjective component. Of course, there could be other things that we missed in the model in there, but the important thing about this subjective component is that, and this is where we tried to add value to the literature, is to see actually which of those components was more informative of default, of actual default, using the defaults that we have over the last sort of 30 years or a bit more. And what we found, and to our surprise actually, was that the objective component of ratings was a good predictor of default at all horizons. We looked at 3-year, 2-year, 1 year, whereas the subjective component of default, put it in inverted commas, subjective component, because there could be other things in there. So that component wasn't informative at all at the 2-year horizon and at 1 year. And at the 3-year horizon, we found that it was actually biased in the wrong direction, that it was actually boosting ratings when it should have been saying that things were getting worse. It was only within a year that the subjective component was useful in predicting default. I think this highlights the problem that credit ratings agencies have, particularly with sovereign default, is there's just very few default events to go on. And when you've got so many possible variables that impact credit worthiness, you just, how do you estimate the weights that you put on those? And they might be time varying in an ideal world. And so it's incredibly difficult. And that's, you have this subjective component. And of course, everyone should and have the right to have their view. The question is whether through regulations, whether they should be forced to accept these views and things. So we found that the biggest casualty of this subjective component was by far and away the Eurozone periphery during the 2009-11 sovereign debt crisis. That will come as no surprise. Others have found that that's where the biggest residuals were, that are hard to explain. And we simply don't really know why that is, but it feels like it was a lack of a lender of last resort, or perceived at the time, and that the OMT probably was a game changer in that respect, whatever it takes. But then we didn't see the upgrades that we probably should have got from after that, and at least not to the extent that one would expect. And the literature has found this asymmetric response, that during recessions you get sharp downgrades, during recoveries you don't get back to where you were before. So there is this creep downwards. In terms of the, why has this time been different? I think it's been really striking. I mean, particularly in Europe, that we've seen very few downgrades. I mean, there's only, in terms of the big ones, Fitch's downgrade of Italy back in April last year. And I think that is a big surprise. I personally would have expected, looking at the aggregate in the Eurozone and across Europe, more downgrades, actually. I mean, if we go through all the good reasons that Judith talked about and mentioned, this time is different. COVID is an exogenous shock. I agree with all that. It's likely going to be shorter in length. We'll see a much quicker recovery to pre-crisis levels. But we have had a big fall in output, and there has been a huge rise in public debt. And then the question is, has the weights of the model changed, or what has happened there? Because they are in the objective sort of model, whatever that is. I mean, some of the rating agencies are more transparent than others. Moody's publishes their scorecard. I mean, there's still some openness in there. They probably go further than others in my view, in being transparent on the objective component, if you will. In terms of strong fiscal monetary response, I mean, I think the important thing about that is that, particularly on the fiscal side, is that there will be less economic scarring as a result of this crisis. But you still, in terms of the model, you've got higher public debt levels, and the question will be, how sustainable is that going to be? It's certainly not sustainable at the moment. Most of those, that increase in debt level will surely be one-off. But a lot of the governments now will have to put in place plans to return the public finances to a sustainable path, and we'll see how that goes. So there could be downgrades to come. On monetary policy, clearly the reaction has been quicker, stronger, particularly by the ECB, also explicitly with the PEP trying to eliminate, reduce spreads as well, which I think is a bit of a game changer. And of course, the ECB went further this time on conditioning their eligibility, not on current ratings, but on those enforced prior to the crisis for eligibility as collateral. And the Fed went even further in their purchases of corporate bonds. They actually purchased below investment grade for those that were judged to be investment grade before the crisis. So in terms of low starting point for ratings, I can see why you wouldn't get so many downgrades in terms of if any particular sovereign, because you're already starting from a lower starting point, but you would expect some effect at the margin, unless the model is incredibly non-linear. The fundamentals have deteriorated. I mean, in terms of if you look at the debt to GDP, which was always very important in the past in predicting what happened to ratings, and maybe there's more emphasis now on debt servicing. Right? Both of those should be in the model. Debt servicing costs, of course, both are useful, and you don't want to rely on any single one. interest rates are incredibly low. That's made the debt more sustainable. Well, what happens in the future if there is an interest rate shock? I mean, when I first looked at this problem and considered it for this presentation, I kind of thought, well, it is a kind of a symmetric shock, this COVID shock. And therefore, if ratings are relative, then you get this maybe no change. But the reality is that it has been asymmetric in nature. There's clearly some that have been worse off, but hit by the health situation more. Some of governments have done much bigger fiscal responses. And it's not necessarily the case that stronger fiscal response has meant stronger recovery, because some have been hit more by the pandemic itself. So if you just correlated those two, you wouldn't necessarily get a nice correlation. So there are some that have been worse off by this, and there is a lot of unevenness in the recovery as well. And I would expect some reflection of that in at least from the model part of the ratings. So that was sort of just an open questions, and I don't know the answer to that. I heard Alexandra's answer, and I agree with a lot of those points. But then that is what has really changed from the model. I'd like to see the model part and the subjective part. That's it for me.
Thanks very much, Daniel. I think I called you David now before. I'm really sorry about that, but I don't realize. Thanks very much, Daniel, for this. It's very interesting, and I'm gonna let, of course, Alexandra answer to that. But before I do that, actually, what I get from those three presentations, especially as far as sovereign ratings in Europe are concerned, I realize how much the institutional framework and the institutional macro policy framework matters. This is what Judith said. This is what Alexandra confirmed, the role of the ECB in particular, the creation of Next Generation EU. It seems very important. And also it is what Daniel mentioned. And he was wondering actually why in 2012, when we got the lender of last resort that was missing from 2010 to 2012, why we didn't get upgrades. I think that's a very interesting question. And so Alexandra, the question, of course you can reply to Daniel, but the question I would like to ask you is, yes, how much does change in the institutional framework, because we have seen a lot of innovations actually since 2012 in the Eurozone. In 2012, of course, there was the OMT and the whatever it takes from the ECB, but there was also the European Stability Mechanism that was created. It was the beginning of the banking union that was then put in place in 2014. In 2015, we got QE. So we've got a lot of institutional innovation between 2012 and 2015, and you seem to say that actually basically making the monetary union more complete is very important for your ratings. But it's true at the same time that the ratings were not improved that much by those improvements in the monetary union. Maybe it was because you believed that the monetary union was still incomplete. And actually, I share that view, and I've been repeating that for years now, that the institutional framework was still imperfect. So maybe that's why rating were not improved. But yeah, my question would be, yeah, how much this institutional framework matters for rating agencies?
Yes, Gregory, I'll absolutely get to your questions, but I think at first I'd like to really get back to a few points that Daniel made, if I may.
It's fair.
So, and there were many things in what you say, Daniel, that I would like to react to. So, first thing is that just getting back to the definition of a rating, which is a forward-looking opinion on the creditworthiness of an entity. And it's true that the forecast horizon is 2 to 3 years, because it's hard to forecast numbers, beyond that. But the rating horizon is actually long-term, and there's no end to it. And that's really important, because it really gets to us looking ahead of the short term on some of these time horizon. The other thing is ratings are not designed to be static. They are really reflecting our forward-looking analysis of what's happening in terms of sovereign, you mentioned a model. So here again, we have very transparent methodology. Our methodology is available for everyone to look at on our website. It's very precise. It explains how we get to each factor. In addition to that, we do publish the sovereign risk indicators that feed into the methodology every quarter. And also for each rating in our analysis, we provide all the scores that we use and all the modifiers, all the steps. So it's possible for anybody in the market to do a regression analysis and reconstruct, understand all our sovereign ratings. So it's really, I mean, this part on transparency, I think, is critical. And so I would encourage if you haven't done it to have a look. We have what, you know, I'd like to come back on the subjective and the use of models. So we have a framework. It's not a scoring. So it's not a quantitative model where you put in, you know, 10 ratios and you get a rating. And what you call subjective is what I would call the expert judgment, the opinion. And that what differentiates us from a scoring model. And that, you know, probably if you had applied a scoring model in a situation like the COVID pandemic, you would have had massive downgrades because it would have been mechanical. Applying an expert judgment really enables us to understand what's unique in a situation, to look ahead. And our approach here has been, this is a temporary shock. And we want, you know, to see what are the implications longer term on the ratings. So, this is, you know, what I think the market values is to have this expert opinion. So, and by the way, probably if you had applied, if we looked at your study and we've had a look at it, you know, where ratings are now 10 years after versus at the time of the study, actually, you know, I think the direction that our rating took have been confirmed for some of them. So what constitutes a rating? And that I will get to the point from Gregory here on the sovereign. There are 5 different dimensions that we analyze to assess a sovereign rating. And this is based on our analysis of sovereign default over a century. And we do publish every year default and transition study that actually demonstrate the validity of our approach. Just to give an example, the 7 sovereign that defaulted in 2020, they started the year prior to the pandemic with a rating of B and below, just to indicate, so at the lower end of the rating scale. So which are these 5 factors? One is the institutional framework, and that gets to what you were saying, Gregory. It's a very important part of sovereign rating. It gets to the predictability of the institutional framework and the transparency and the governance. And for Europe, indeed, we've seen that for us. This EU Next Generation has been a step in the positive direction. The economy is very important. You know, both the economic resilience, its diversity and growth. And that's why we put so much emphasis on economic growth here for the future of sovereign ratings. Monetary flexibility is another critical factor. And that's why the actions from the ECB here, I mean, it's hugely different from what happened before. They've been timely, they've been very large in scale, and really what this has enabled is to remove a critical risk, which was a sudden risk of losing market access, which is what could precipitate default. And this is the situation where we were before. So monetary flexibility is really important. And then you have the external imbalances. And here having a reserve currency helps in our methodology. And then lastly, you have the fiscal analysis. And fiscal is both the fiscal performance and flexibility. So we haven't changed the weight of debt to GDP. We still look at debt to GDP. It is important, but it is one of the factors. And with a same debt to GDP, you could have a different rating depending on your economy and your flexibility. The cost of debt matters. The structure of the debt matters. But ultimately, what's going to be really critical for us here is to see the government's ability to implement some of structural reform and that will sustain the return to economic growth, and that will then be reflected in the rating. So there are many other things that I wanted to react to, but I will just pause here for now.
I don't know if either Judith or Daniel wants to react immediately. Otherwise, I'll start taking questions from the audience. Do you want to react to what was just said, or should I take a question from the audience?
If I may, I just add one
Sure.
thing, and that is Alexandra talked about the low yield environment now and the debt servicing costs, which I mean I think is very important indeed, and the ECB reacted quickly and more strongly this time round. Of course, back in 2010-12, the rise in yields and the increase in cost of debt wouldn't have been nearly as bad if it wasn't for this pro-cyclicality of ratings, where you had, of course, the quick money leaves, and then ratings get downgraded, and then of course others are forced out as well, either forced or guided by the ratings, and that was self-fulfilling, and that Eurozone debt crisis was exacerbated by the actions of rating agencies, and I think this time around it's welcome that you haven't had that.
Maybe just in reaction to that, one thing we fully agree on, we've long supported, is the over-reliance on mechanical rating triggers. Because indeed it's more the use of the rating or the over-reliance then that can have this mechanical effect on the market. And really, I think it's been really quite striking to see here for COVID that the ECB, the Fed, and the Bank of England all took measures to actually expand their support to the so-called fallen angels. So the credit that had lost their investment grade rating during that period since the trigger of the pandemic. And immediately after these measures, you could see in the market the spread compression for these credits, which have continued to benefit to access to liquidity.
Yeah, from my perspective, I think that procyclicality has two different angles. First one is that, as I was saying before, maybe credit rating agencies are excessively procyclical in their behavior, and that's what happened during the euro area sovereign debt crisis. Hopefully, unfortunately, it looks like this is not happening during the COVID-19 crisis. But the second element is the one that Alexandra was mentioning, and it is that there's an over-reliance on ratings for a number of factors, and that increases procyclicality. So the fact that, for instance, central banks' collateral policy depends on ratings in terms of eligibility of the assets, in terms of haircuts, that's a clear element. And indeed, there are some mitigating actions that we're seeing right now, as Alexandra was mentioning, but also from the private sector perspective, investment policies many times are built around credit ratings. So a fallen angel can trigger divestment by investment funds depending on their investment policy. So this has two different angles, and I think that it should be mitigated both from the side of credit rating agencies, but also from a policy perspective. And going forward, and regarding the question that you raised before, Gregory, so it looks like indeed the institutional setup of the euro area plays a crucial role in determining credit ratings of euro area sovereigns and corporates. So this is a clear message that is being sent. So it looks like we need to further deepen the EMU. So in terms of introduction of a fiscal capacity, in terms of not leaving the common debt issuance with the next generation EU, but building it further for the future. So this is a very clear message that is sent in terms of deepening of the EMU.
Indeed, and if I may add, actually, on the points that you made about the ECB and the ECB's reliance on rating for its collateral framework, actually, I'm wondering, how do rating agencies deal with that? Because in the US, or in the UK, it's easier because the Fed and the Bank of England do not rely on ratings for their collateral framework. Actually, the Bank of England has been taking Italian bonds at a stable haircut during the whole euro crisis, and actually since then. So I was wondering, maybe it's a question for Alexandra, if you take that into account when you discuss the Eurozone, because actually your rating, they depend on what the ECB is doing, but what the ECB is doing depend on your rating. So you see, there could be either virtuous circle or vicious circles. So I was wondering how much you take that into account when you design ratings for the Eurozone, which has this very peculiar feature.
Well, so when we assign a ratings to our ratings committee, we apply our methodology, and so we can not choose to ignore when there are changes in the creditworthiness of an entity by the consideration of the potential effect of a downgrade. We are regulated. We have the IASCO code of conduct, and we would be prohibited not to apply our methodology. So and that's really to protect the independence of our analysis. So if the situation, if there is a deterioration in the credit conditions or in the creditworthiness of an entity, then we have to reflect it in our rating analysis.
Good. Actually, it's good that you mentioned regulation, because I need to also look at the question from our audience. And I see that the most popular question on sil.do is actually a question from one of my colleagues from Bruegel, Alexander Lehmann, and he's asking about the regulation of credit rating agencies at the EU level, and he's wondering if this has changed something, if the regulations reforms that we have seen in 2009, 2011, 2013 that were mentioned by Judith at the beginning of her intervention have changed and have really played a role. Maybe Judith, given that you mentioned that in your intervention, can you tell us a bit more about the EU regulation of credit agency? Do you think it played, you mentioned it at one of the possible drivers, but do you think it played a major role in modifying and making this time different?
Yeah, indeed, as I mentioned, I think that the regulatory reform that started back in 2009, there was another reform in 2011, and final reform in 2013 has indeed played a role in reducing over-reliance on credit ratings, in mitigating the lack of transparency of sovereign ratings, in eliminating the absence of liability of credit rating agencies towards investor losses, and eliminating any possible conflict of interest and high market concentration. That's clear. But this being said, I think that much remains to be done, or at least there are some elements that still need to be tackled. And clear proof of that, as I was mentioning before, is that there's still an over reliance on credit ratings, which to some extent, it's understandable that investors need to rely on credit ratings, because it's a way of reducing asymmetric information and also providing an analytical tool that otherwise would need to be done individually. But this being said, maybe once the COVID-19 crisis is over, depending on what we see, further review could be warranted. So indeed, also from a strictly prudential perspective, the fact that the central banks simply allow fallen angels to be used as eligible collateral. I don't want to criticize that measure at all, but maybe it's a bit counterintuitive that something that you deem is not creditworthy can be accepted as eligible collateral. So maybe some further food for thought is warranted here, and some further amendments could be needed. Thank you.
Just maybe if I may give my thoughts on that, Gregory. And so the answer to the question, is it regulation that's changed the approach to sovereign rating? The answer is clearly no. It's really the factors that we mentioned before in terms of its different nature of crisis and very different policy response. Now, what regulation has done since the last financial crisis is really introduce several requirements to enhance the transparency. And there are specificities for sovereigns, such as the sovereign calendar. So we have to publish a calendar of sovereign actions. Rating actions are on the Friday after market hours, and there are specific disclosure requirements. But at S&P, we really take this commitment to transparency very, very seriously. It's we beyond regulation, it's at the core of what we do. As I mentioned earlier, you can find all our methodologies. All of the rating action are clearly explained. And also just wanted to mention that for COVID, we created a special webpage at the end of January, and we've put all our COVID-related research available free of charge to anybody in the market, so that everyone could see our assumptions on the pandemic, on the macroeconomic assumptions, the impact on ratings across asset classes.
Thanks. I realize that time is running out, and actually we only have like 3 minutes until the end of our event. So maybe I'll give you the floor to the three of you in reverse order, so that you can conclude, and maybe also on a positive note, in order to be sure that really this time is different. What needs to change for this time to be different, according to you? And I'll start with Daniel, then Alexandra and Judith. Just 1 minute, please, because we need to finish at 2 sharp. Sorry, Daniel, you're muted.
Sorry. No. Yeah, I was saying, in terms of the Eurozone, I think clearly there's been progress in terms of the institutional framework. We've had Next Generation EU. That is a game changer in terms of its signaling, not so much in terms of the amounts of money spread over a lot of years. There's not still really, the fiscal response is down to the member states still, but it is, although meant to be temporary and one-off, the Next Generation EU, it nonetheless sets a precedent and shows solidarity. And I think that's important. The ECB clearly has done more this time, targeting spreads and going into areas that they haven't done before on the collateral framework. And so that's all completely welcome. I still worry that rating agencies are not transparent enough. I'd like to see the separation of what is objective and what is subjective. I don't really want to have to go and do some regression analysis with variables that are mentioned in their rating methodologies and try and back it out. I would like to see the full model, and I do think, and I hope one day rating agencies will sort of acknowledge that the Eurozone debt crisis, their role in it, didn't fulfill or didn't cover them in glory, certainly, and they made it worse. And I think Fitch, back in after the Asian financial crisis, they admitted that they were maybe wrong and they made it worse. So maybe it's just time that we need. But certainly during this crisis, it's welcome that we haven't seen the downgrades that were done back in 2010 and 12.
So on my side, I would like to invite Daniel, if you're interested. We can, happy to explain in detail our sovereign methodology and walk you through the approach as a follow-up from this meeting. For me, really, the key message is that we're not out of the woods yet. And I think that there are many challenges ahead for us, globally as an economy, as a community. And I think here in Europe, what's really going to be critical is all of the structural reforms and the investments that are going to support the creation of jobs in sectors of the economies that are growing and that are going to support a sustainable growth for the European economy.
Thanks. Judith, your final word?
Yeah, so thank you again for hosting this event. And basically, as I was saying before, up until now, credit ratings have not been as procyclical as during the great financial crisis. This is good news. This is key for financial stability. As Alexandra was saying, we're now not out of the woods yet, so let's see what the story ends. But in any case, the main message that I take with me today is that in terms of sovereign ratings, the institutional framework is key. We are in the euro area, so this means that a reinforcement of the institutional framework needs to go on. We cannot always solely rely on the ECB doing whatever it takes. Also, fiscal measures are needed. So indeed, a very strong word to keep on fighting for joint fiscal capacity at euro area level. Thank you.
Yes, thanks for this constructive final point on the EMU reform. We could really continue this fascinating discussion for hours, and I think we should organize a more technical workshop on the methodology behind the ratings. But unfortunately, this event is coming to an end because our hour is over. But I would like to thanks very much the three speakers for this lively debate and interesting points that they all made on this important topic. So looking forward to see you again and discuss this topic further with all of you. Thanks very much.
Thank you very much.
Thank you very much.
Thank you. Bye.
Bye-bye.